Hey everybody, this is Jose Blasco. This is a sound check. Could you please confirm with a quick message in the chat box that you hear me well? That would be appreciated so I know we are ready to get started. I believe it's all fine, but just in case. Wonderful. Perfect. Very nice, everybody. Welcome to the session. The session has now officially started. Today is July 16, 2020. Welcome to the Get Together trading session. Today we are getting together to talk about longer term trading. This is the day where we take a look at options. We look at directional, non-directional opportunities, anything the market could bring us. As long as it meets our rules, we'll be ready to execute. And if not, we'll just move to another asset, another trade, another opportunity until the opportunity does meet our rules. That's the plan. Before we start, I have a disclaimer to read for you guys, and from there we begin. So disclaimers, the following videos, clips, demonstrations are for educational and instructional purposes only. Tradictive provides these videos purely for the purpose of demonstrating a method of using the product. Users understand that all the content used in the video is purely for demonstration purposes only and is not a guide and does not provide any indication or prediction of actual results. As a user, you understand and agree that hypothetical results obtained through a demonstration do not indicate in any way the results you may receive when using our products. Here we go. The session is now officially introduced, so we are ready to go. So I'm just gonna move to the TradeStation platform. Take a look at the messages on the chat box. Leland, how are you? Good to see you. By the way, Leland, I did respond your email, but I didn't get a response back from you. So make sure you take a look at that email. Maybe it's in the spam folder or something. Make sure you get it because I want to help you with your request the other day, okay? Furman, how are you? Good to see you. Good to see you all, everyone. Let's begin, my friends. Okay, so what did we do today? Well, again, trading is about being systematic, being mechanical. So what did I do before the market started? I turned on the scans on TradeStation, and the 5 scans that I care about when we do our get together longer term are the 5 scans I just highlighted, where the 2 on the top are for directional trading, directional long, directional short, isn't it? And then the 3 below are credit opportunities, where the ones in the middle are purely non-directional trades, hence the ND for non-directional. And then the 2 below are also non-directional trades in a sense that they are credit trades, so we make money on time passing more than direction. But there is a bias when it comes to the direction in this case, and therefore we call them neutral long and neutral short. Okay, so basically we have 5 types of opportunities: purely directional long and short on the top, non-directional, purely non-directional in the middle, and then a little bit directional to the upside and to the downside. We call that neutral. Those are the 5 types of opportunities that we have, and we're gonna go ahead and look into the markets and plan trades out of that. Before we start though, I would like to review the trades that we have in the accounts since we started. Okay, since we executed those trades, so that way for educational purposes, I believe it's gonna be handy to do this review. I'll start with Cigna Corporation. Very good, Lilan. Wonderful. Miguel, how are you? Mark, how are you? Good to see you, Mark. It's been a long time. I haven't seen you around. I'm very happy to see you. So, Cigna Corporation, this is a non-directional trade. We set up an iron condor on that stock, isn't it? That was back on June 19. Okay, that was the vertical line, and this would be the entry price. That was the moment where the trade was taken. This trade was a non-directional trade, an iron condor, where we were expecting that stock to remain inside the purple box, okay? Meaning below 221, above 162, and this has to do with UFOs, obviously, but also up to July 17, which happens to be tomorrow, given the fact that tomorrow is the expiration date of the options used, okay? So this was a trade that seems to be working well. The current price for Cigna is right here, 180 something, okay? And as long as we don't hit 162 tomorrow, so this trade will basically expire with a full profit. And this is, by the way, the way to deal with those trades if you were to approach non-directional trading, where you just place the order and you just wait until the expiration date and you do nothing at all, okay? Which is not the ideal way to approach trading. Approaching trading, given the dynamic changing conditions in the marketplaces, it's always a better idea to go ahead and work on some trade management rules. And therefore, at this time, you should be out of this trade since a few days ago. Okay, but again, in these initial stages, talking about iron condors and so on, I'm just being very simplistic, very purist, and just assuming that you're going to be in the trade all the way to the end, right? And in this sense, we can see the probabilities working, the UFOs working. So probabilities were set by the dotted lines. Okay, so probabilities would have suggested that price would not surpass the dotted line, and price did surpass the dotted line by a little bit. Okay, then came back inside. So again, probabilities are helpful, but that's why we use UFOs on top of probabilities, because probabilities is just a number, where the UFOs that we have below, if price was to come to 167, 163, they are likely going to push the prices back up. We just got a new UFO form yesterday at 178. So all of this is likely going to push the prices back up and allow for the trade to stay within the range for longer, which is how you make money when you do non-directional trades. Okay, so again, those reviews are for these concepts to click in case you have not traded much non-directional opportunities yet. Hopefully this visual is helping you to understand. And if it's not the case, please go ahead and type a question. If you have any question, I'll be more than happy to help you with that. Okay. So this is CI Cigna Corporation. What else do we have? We had a trade with Gilead Science. And by the way, let me turn on Option Station Pro so I can show you the trades that I have in this in the account I use for the sessions, which is a simulated account, which are trades that sometimes got filled, sometimes didn't get filled. You know that in TradeStation, when you use simulated accounts, you only get filled at market price. You don't get filled with limit orders. So unfortunately, I will not be able to demonstrate all the trades I will show you on the chart. Okay, but some of them are there, and one of them is Gilead Science. Okay, so Gilead Science is a trade where we bought a call. Okay, and that option is about to expire. We're 8 days away from expiration date. Okay, and basically, we paid 198 to get into this trade. We are currently losing 172. So basically, that stock didn't move at all in our favor. Okay, this is a trade where really we didn't get to experience any joy. So we did the trade, and here I actually forgot to have the vertical line, so I don't remember the exact date we entered this trade. But whatever day that is, you can see price went up, and then it went down, and then it went up, and then it went down, and basically price is in the same place, right? So it didn't went anywhere, and time passing was decaying the value of the option. Okay, so that is a problem. So what could we do with Gilead Silence? Okay, well, first of all, doing nothing is fine, because we assume $198 of risk in this trade, and we knew that maybe nothing would happen, and therefore we lose 198. So that's part of trading, and we are okay with that. In parallel, we made a profit on the Microsoft trade. We made a profit on the CVX trade. So again, you have other trades running in parallel. Okay, but the point, and here's the reason for this conversation, is that on July 21st, okay, sorry, July 22nd, okay, July 22nd, we have the earnings report. So July 22nd happens to be next Wednesday. Okay, next Wednesday. The options we're using expire on the 24th, which is 8 days from now. Okay, 8 days from now. So next Wednesday, which is the 22nd, earnings will take place, and sometimes, not always, but sometimes when earnings take place, stocks will jump. So if on earnings price was going to move above 80, this trade, which currently it's basically losing all the value for us, which is 198, is currently losing 172. So may end up with a little bit of joy. Okay, let's say that stock was to during the remaining part of this week and beginning of next week, it was to do something like that, and then with the earnings gaps to 82, okay, and then rallies. Well, I'm okay with missing the rally, but if it gaps to, let's say, 82, the price of the option was 1.98, isn't it? Let me show you. So the price of the option was 1.98. When you see the trade cost is 198, it means that 1.98 was the price per share. So you will need the break-even point for this trade. Okay, the break-even point for this trade would be to have Gilead Science trade at 81.98, and then you would make $1.98 while you have lost $1.98, so you will break even. Okay, so in other words, if thanks to earnings we have a jump, and this could happen, and price rallies, okay, actually look at that day, for example. Only one day price went from 75 to 88. So this could be a volatile stock. So we may end up in a profitable trade. So right now, there is no point on closing this trade, even though it went against us. Time passed. We got 8 days to go. Well, it's part of trading. 198, this is what we're risking. It's looking like we may lose 198. Okay, but so what? Leave it open until expiration. And that I will say, if on the earnings date, which is the 22nd of July, you do have a gap and you do surpass 82, go ahead and close the trade, because then if you were not to close the trade, you would then fall into greed, and you may you may see the stock gap to 82, and now you're like, oh, I'm making some money, I'm going to keep it for longer. Next thing you know, it turns like that, and then you just lost the whole thing. Okay, so if on earnings you get to see this trade to become either break even or profitable, just get out and be happy with avoiding a loss. That should make you happy enough to exit this trade. Okay, so a few comments when it comes to trade management. What else do we have? We have CVS. Okay, this is another trade that we executed. So notice how this trade got us filled on this particular day. Okay, it went against us all the way. Okay, why? Because that was the time a few days ago when the S&P was pushing hard to the downside, and we know stocks are fragile, and therefore, when external forces such as the S&P or a sector is pushing in the opposite direction, then the stocks will suffer such consequence. Okay, so we know that this is nothing new, right? So what's happening here? Well, the stock went against very badly. Okay, but then came back up, and not only that, 2 UFOs has been formed since then. The climate change from red to blue is not confirmed. Okay, but those UFOs, that one formed today, is likely going to bring the climate to be confirmed into tomorrow. So in other words, we may start seeing that CVS trade to start being profitable. As of now, because of the time decay that passed, CVS is showing $13 of loss, which is just a little bit, given the fact that basically the current price of the stock is more or less the same price when we entered. But again, of course, we have the time decay element. Okay, and this trade with CVS still got 36 days to go. Okay, as well as when looking at earnings with CVS, okay, we got the earnings happening on August 5. So you have to keep this in mind. If you are in profit, okay, so let's say CVS is gonna rally, and maybe you haven't reached your target yet, okay, but now August 5 is about to happen, and you are in profit. And you may have a gap that makes you even more profitable, but you may also have a gap that makes you lose a lot, right? So what you would want to do is before August 5, get rid of the trade, okay? If you are losing, okay, then let's play the luck factor, if you wish, okay? Because you are already about to lose the whole thing, given the fact that the option is about to expire. The whole thing in this case would be $152. This is the cost. This is the amount of money paid for this call on CVS. So if you are about to lose the whole thing, just leave it alone, because the earnings may push it in the right direction for you. And if it doesn't, you lost what you were ready to lose. Okay, so which is a similar situation that it's happening to Gilead Science as we speak. Even though with CVS it looks much better, and it does look like CVS will begin its way up with a climate propagation. Okay, so we'll get to see that. We'll be reviewing this in the future sessions as well. Okay, what else? Roku. This one is a trade I planned in the last session. We didn't get filled. Okay, we didn't get filled. Okay, so I'll have to delete that chart at some point. But yeah, that was the day where the trade was planned. Okay, this was the day where the trade was planned, and we were ready to buy at 116. But notice how price just kept going higher, never came back to 116. So we never got filled on Roku. Caterpillar. So Caterpillar is a non-directional trade that broke the range. So this is a losing trade, okay? And that one, I remember, I believe, let's take a look. Yes. So that one, I remember that even though I did not get filled, okay, I did mark the price of the trade to be 15. So I did not get filled on the account because I told you that with a SIM account on TradeStation for options, they only accept market orders, not limits. Okay, and you could not get 15 cents of credit with a market order. It's just impossible. But in the real world, you could. But not in the simulated account. So what I did is I just marked the price here. So that way now I can come back and show you what the current P&L of this trade would be. Okay. So if you were to close this trade now, you would lose $40. Why would you lose $40 on the trade? Well, you would lose $40 on the trade because for this trade to profit for you, okay, and that trade, by the way, has an expiration date on July 24. So for this trade to profit for you, you need price to stay on the purple box. But notice how there is a severe violation of that purple box. Okay, we are beyond, and that's why we can see a negative $40 P&L. So again, for sure, we can do many things here when it comes to acting on this before this happens. We can have a buy stop. We can convert the iron condor into an iron butterfly. We talked about some of those things in the YouTube channel before. You can watch some of the recorded videos on a damage control mode. Okay. And you will understand other possibilities. But as of now, as I said earlier, I'm just treating this trade like, you did a trade, you close your eye, and you wait until July 24, which is the worst case, okay? And then we'll see what happens. So we can learn from that experience, okay? And later in time, we'll certainly find time to get a bit more advanced as well with management and so on, okay? So this is what we have now. And again, this could certainly come back down and end up in the middle of the range on July 24. But right now it's outside, and you can see that negative P&L, negative 40. Okay. And the last one is Nike, which this one is also a trade where we got filled. Okay. So the trade was planned on that particular day. Okay, was planned on that particular day. This was a trade. Take a look at Nike. This is not a trade to make money when the markets go up. This is a trade to make money when the markets go down. We bought a put on Nike. We got 92 days to expiration. Okay, this because it's longer term expiration. So this was a pricier trade. Also, the price of Nike is more, $97 instead of 65 or 75. So it's more expensive stock. So and more time, so more premium. So $385 is the risk of this trade with a put. Okay, and so we got filled on that particular day. Okay, so that was the day where the trade was planned. Okay, the purple line was the entry for the short. So price went up, we got into the trade, and now the expectation was Nike falling. Instead of falling, what Nike has done is go up, go down again. So it's basically going a little bit sideways. It's now back to our entry price. Okay, and therefore the drop of premium out of having that stock behave calm and therefore volatility dropping, together with a little bit of time passing, that's the reason for that negative $32 loss. Okay, but what's the beauty? The beauty is that I have some hedge in my account. Okay, I have some hedge in my account because again, Gilead Science and CVS are opportunities that make money on the way up. They are calls. So if the market rallies, those two trades are going to make money for me. Nike will probably lose money for me. Okay. Now, if the market falls, Nike will make money for me while Gilead Science and CVS are losing money for me. So I got a little bit of a hedging effect, which again, if you haven't watched it yet, in the YouTube channel, there is information about gamma hedge and building a portfolio and things like that. So it would be good for you to go ahead and take a look at those lessons. Okay. Ahmed, how are you, my friend? I can see you're with us. We had the CDX, these stocks went to the max loss, and then back to our target. Exactly. And that's why we use the beauty of time with the options, where we run multiple trades in parallel. And when one trade goes against you, in one hand, it's obviously not nice, it's not ideal, but it's part of trading. So we know that, not an issue. But in the other hand, the beauty of having one trade move against you is that if you build your portfolio correctly, other trades are moving your way. And as other trades are moving your way, you collect those profits, okay? And then if the market corrects or changes direction, those trades that didn't work well now are back to break even or profitable. And in the meantime, you added more trades. And again, you just keep this machine running. And if you do it right, it creates nice results in your accounts. Again, it does require management, okay, because it's all dynamic. But again, it's a bit too hopeful to just plan a trade and hope for the best and leave it like that for a month, right? So it would be a bit too hopeful. Too many things happen nowadays, especially with computers managing the whole thing. Okay. Anyway, a long conversation, 20-minute conversation to go over trades. Okay, I am eager to get into new trades instead of the prior trades, but hopefully this is a review that is useful to you guys. And by the way, I'd love it if you could comment on the chat box. If you could just type a little bit on how do you feel about this type of reviews? Is it helpful or not, or you prefer that I just stick with planning trades and that's it, or you do appreciate the fact that we go back and check the trades that we executed before. Okay. While you are answering this question, I'm just gonna sort my non-directional stock trades. I'm sorting them up based on the price. Okay, we got Google on the top. Okay, and nothing wrong with Google, but I'm gonna skip it. Okay, I'm gonna skip it because it's a very pricey stock, and since I understand that most of you joining are in learning stages, probably that's gonna be too big as a bet for a learning trade. And you can always execute that in a paper money account. But if I give you trades that are to be executed in real accounts, you can also execute those in a paper money account. Both are going to be your decision, but that way I kill two birds on one stone, which is to give you let's call it usable trades and trades for practice at the same time instead of only for practice. Okay, here we go. So Leland, thanks for the review. Nice. Ahmed is very helpful. Nice. Love it. You checking previous trades. Very nice, Fairmont. Love it. Love it. Love it. Love it. Fantastic. We're in the same page. So I'll start with now. Okay. And with now, if I look at pre and post market data, I do have two UFOs here. And when I look at regular session, I got 45% UFO performance stat. And when I look at regular session data, I do get 53%, which is very nice. But unfortunately, I don't have red UFOs. Okay, so even though I got now in a non-directional list, I could only use now for credit spread purposes, which would be neutral long. Okay, so we may check that later on. What about Facebook? Okay, so with Facebook, we have a situation where we have one UFO and it's 49%, so that's okay. What if we look at pre and post market? We have 47% and we got two UFOs. Okay, and that's not good. That's not good because for a non-directional trade, we need this figure to be at least 48%. And you may say, wait a minute, it's almost 48. Can we do it? The answer is no, because if you're gonna, and I'm not saying that's your intention, but if you're gonna find excuses to break the rules, then next thing you know is gonna be, what about 46.8, right? So, and next thing you know, we don't have a rule. So it's either 48 and above or it's not. In this case, it's not. So we are just gonna pass on Facebook. Is not valid for a non-directional trade because for me to get that 47 higher, I need to move to regular session. Now I got 49, that's valid. But then I only have one UFO, a red color UFO, it's only one. And we have a rule, which is I need at least two, okay? IWM is an ETF, so I'll skip that one. ATVI, let's take a look at ATVI. So pending data, so I'm just gonna wait. You know what, I'll click on CSF and also on COF. So all those data start the loading behind the scenes. So back to ATVI. Here we go. So ATVI, we got 57%. This is really beautiful. Where are we at in the big picture? So almost going to make all times high. So the last time we made all times high was September 18. So I would like to load data here starting September 18 to understand the reality of ATVI in the sense of, do we have more UFOs above or we don't? Okay, so let's take a look. So pending data. Okay, so we're just gonna wait. And we do have more UFOs, as you can see, okay? So, and they are 50%, okay? So we have more UFOs, actually one more. So we have the two UFOs we need, actually. What about pre-post market? Pre-post market actually give you three UFOs and give you 51%, which is even better. Okay, so we're going to be working with pre and post market with ATVI. Before we get too excited, let's go ahead and look at ATVI. Okay, ATVI, and look at the earning date, which happens to be August 4. So August 4 is nice. Okay, and the reason why I said that is because when you look at the calendar, August 4 is allowing you to use either the 24th or the 31st of July. August 4 comes in the next week. So 31st or 24th is good. Okay, so we can use two different expiration dates. My only concern here is that I have traded options on ATVI before, but not too many times. And what I do remember, and again, it's out of memory, maybe I'm wrong, but I do remember is that liquidity was just okay. So I'm a bit concerned in the sense that the 17th of July, which is the one expiring tomorrow, that one is going to be nice because that one is the monthly expiration date. But if instead of 17th of July, here, notice that 79, for example, we have 40 to 45, we have 5-cent spread. So what if we look at 24? Is it going to be nice enough? So, oh yes, it's nice. 140, 145 is nice. So my memory when it comes to liquidity for that stock was inaccurate. Okay, I thought it was less liquid than that. So I'm very happy to see this. So what are we going to do then? Well, very simple. We're going to right click, I should say left click first, and then we're going to right click anywhere in the option chain to analyze and sell an iron condor on ATVI. I selected plus 1 standard deviation, minus 1 standard deviation, and that tells me that with the date being July 24, statistics suggest that that stock would be ranging between 83 and 73. Okay, that's what statistics suggest. So let's add those lines to our chart. Okay, 73 and 83. I'm going to make it dotted. Okay, so 73 is more or less here. Okay, 73 something. And then we had 83. So 83 is more or less here. Yeah, so it's more or less there, isn't it? So let me see what we have. Did I do this right? 83 and 73. Yes, those are the values. So my concern here is that the 83 look a bit far for the 24th of July. So how much I get paid? And I do get paid 40 cents. It seems that I do get paid enough. It seems that I do get paid enough. So this is looking good, guys. This is looking good. Let's take a look. So 83 is what statistics suggest. 8307 is the extreme of that UFO. And by the way, we had another UFO with a regular session. Is it the same 8307? No, there is another. This UFO goes a bit beyond. So I'm going to use that one. So that's going to be 84, actually. How much I get paid for the 84? 30 cents. We'll see. I think I'm going to say yes, but I'll come back in a minute and share the rule I'm thinking, and that rule will either confirm or not this particular selection, okay? Then when looking at the bottom UFOs, this is the next one after the dotted line. Now, this would only be one green UFO. So what if I switch to pre and post market? So still one UFO. So I need to go to this one. So I got two. So in other words, I will need to use the 71. So how much I get paid for the 71 put? My friends, we are not going to be able to accept this trade. It is unfortunate, but it will not work. The 71 put is paying only 19 cents. The 84 pays 29. So the rule we have, let me explain this and you'll understand why we are not going to accept it. The rule we have is that the minimum premium we accept is 35 cents when we sell options. We can make an exception and accept a minimum of 25. We could make that exception, okay? But only if, okay, that exception is valid, only if the total amount of premium collected based on the options that we sell exclusively, it's equivalent to 35 times 2, which is equal to 0.70. So in other words, if this one here, okay, if this one here was to pay me 41, okay, so let's say this one paid me 41, okay, and this one is paying me 29. So 41 and 21 and 20 and 29 is 70. So 41 is more than 35, and while 29 is less than 35, it happens to be more than 25, and the total gives me 70. So then I would accept it. Okay, I would accept it. But the problem is that it's not 41, it's 19. So when I add 19 and 29, it certainly does not give me 70, and therefore I need to pass. Okay, I need to pass, and that's what I'm doing. That's what I just did. So we're gonna go for the next one. Okay, you guys with me on that? Just looking at your messages. Okay, so let's continue. So back to TradeStation. The next one is CSX. So let's take a look. Actually, we don't need to load that much data in this case. We only need our 1,597 bars. Here we go. So we got 38%. So this is absolutely not valid using pre and post market. What about regular session? Regular session is 52. 52 is certainly nice. And we have multiple UFOs above and below. So all of this is good. Before we get too excited, let's check CSX. So earnings are going to be happening on, maybe too soon, the 22nd of July. Yeah, that's in the middle of next week, isn't it? That's in the middle of next week. And therefore, yeah, we're not going to be able to do it unless we were to get paid amazingly well. Okay, so two UFOs above is 78, 79. Out of curiosity, how much I get for tomorrow's expiration? Again, I'm sure it's not going to work. I'd be delighted if it works. So 78, 79. It's basically no one is willing to buy those options from you if you want to sell them. Okay, so yeah, it's not going to work. So no CSX, okay, but then we also have COF, right? So COF was the last one. So let's load COF and see if we have a trade. So COF is giving us 39%. That is not acceptable. What about pre and post market? That is 35%, even less acceptable. So we are going to pass on non-directional trades. Okay, none of them qualify, and therefore we're going to pass. Okay. Good. So let's continue, guys. We got around 15 minutes left, something like that. So what about we go back to the list of neutral trades, neutral to the long side. And I remember earlier making the comment. What was the stock? I think it was Facebook. Was it Facebook? Let's take a look at Facebook. Yeah. So Facebook has 49% with with a regular session, has 47.86% with pre and post market. So we cannot use that. When using regular session, the problem with Facebook was that there is only one red UFO, so we cannot do a non-directional trade, but we could look into approaching Facebook as a credit spread opportunity. Okay, so let's see if that is going to work. I'm just going to load Facebook. I also need to find out more about the earnings date for Facebook. So Facebook earnings is happening on the 29. So since it's happening on the 29, potentially we could do a trade using the 24. Okay, 24 is before 29, so we can do 24 of July on Facebook. Okay, so here is the expiration date. Facebook is super liquid, so I'm not too concerned about that. So I'm going to right click and analyze and sell a vertical spread on Facebook. Okay, using 24 of July. And when you look at 24 of July and you look minus one standard deviation, it's telling you 221. Okay, 221. So let's go ahead and take a look at the 221, which is more or less here. This is where statistics suggest that Facebook will not go beyond that line based on stats. Okay, of course we want to be more protected than a simple mathematical calculation, so we're going to use a UFO, and therefore the options we will want to sell on Facebook are the 207, which probably is going to be 207.5, I would guess. Let's take a look. Yes, 207.5, and this option pays 45 cents. Okay, it pays 45 cents, and therefore from that angle it's valid because it does meet our rule of at least 35. So let's go for it. What if we sell the 207.5? Okay, what if we sell the 207.5 put? Okay, and we buy below the 205. Okay, so if we were to do that, we have a problem. This trade will not be accepted, and the problem basically is the total premium collected, which is only 8 cents with the midpoints. Okay, why is that not accepted? Well, because apart from the rule with the 35 cents that I explained earlier, and that we saw that Facebook does meet that rule, we have another rule which has us to look at the distance between strikes, which is $2.5, isn't it? So the difference between 205 and 207.5 is $2.5, correct? So $2.5 is the difference. This is the worst case risk, okay? And we have another rule that says that out of the worst case risk, we need to collect at least 15% of the risk in premium, and that is 37 cents. But wait a minute, instead of 37, we are only being paid 8 cents. So that means that no, it's not going to work. We're not going to take it because the amount of premium you collect in exchange for the risk does not justify the risk to be taken. Okay, so I'm going to move into the next one. Actually, we have another one there with Biogen. So let's look at Biogen. Biogen with 53% probability. And pre-post market becomes 44, so that doesn't work. So we're going to be using regular session data for Biogen. Again, checking earnings. Boyan, I see you join us. How are you, my friend? Good to see you. So with that stock, we are talking about July 22nd expiration. Okay, July 22nd expiration. That obviously forces us, okay? That forces us to use tomorrow expiration date. That's the only one we can use, okay? Because 22nd is next week. So tomorrow expiration is the only one we can use. Good news here is that that stock is quite pricey, $278 per share. So maybe, you know, those UFOs below the 265, the 260, maybe provide premium enough for tomorrow. It's going to be a tough one. But again, if it does work, that's going to be a pretty probable trade, or at least a very efficient trade from a point of view of time decay. So let's find out. I got here already with Biogen a vertical spread using July 17, okay? And it seems that one standard deviation until tomorrow is 269. So if I go back to the chart and I draw a dotted line around 269, okay, so push it down to 269. This is 269, okay? So obviously it seems that utilizing that UFO there would do, because it's beyond what probability suggests, and we got two UFOs to defend ourselves, so that would be the 265. So let's go ahead and adjust this trade by selling the 265 and buying the one below, which is the 262.5. Okay. Wow, it's looking like liquidity is absolutely terrible. Let me take a look. So 265, yeah, look at that. Yes, yeah, we're not going to be able to trade that expiration date. It's really, really bad. From 15 to 30 is not too good, but the next one from 0 to 90 is absolutely ridiculous. We cannot take a trade like this, guys. Okay, we are just not going to do it. Okay, so no Biogen. So back to our trade station, looking for an opportunity, guys. What else do we have? Abbott. Thanks for that, Boyan. Thanks for that, my friend. So we're looking at Abbott. Okay, earnings for Abbott happening on the 16th. So actually that's today. Forget about it. Let me see what else do we have there. Yeah, those stocks are pretty low price points. So okay, so I guess that we are done with the neutral long. What about neutral short? Okay, so we have Shopify, Beyond Meat. Okay, that's another stock. I'm curious to see the stats on that one. I'm not sure if it's going to be tradable or not. So we got 38%. Well, actually, it's still pending data. Okay, so we just need to wait a bit more. Here we go. So it's 45% with regular session data. If we switch to pre and post market, it becomes 48. So 48% allow us to do non-directional trades with it. Okay, so let's go ahead and take a look. BYND. Earnings are happening on July 29. So we could plan on a trade using July 24. We could. So let's try that. So BYND, that would be a credit spread pointing down. So that would be a bear call spread, to be technical. We're going to use July 24, and we're going to use calls. Liquidity is acceptable. Okay, it's not the most liquid stock in the world, but it's acceptable. So analyze and sell a vertical. Plus 1 standard deviation, minus 1 standard deviation, even though I don't care about the minus in this case. I only care about the plus because we are expecting it to go down. So we want to know how far up it could move against us. And the answer is up to 147. Okay, so 147 is here. Let's draw it on the chart. 147 is somewhere here. Okay, this is how far it can move from now until next week based on probabilities. Okay, so this obviously leaves us with one choice, which is we should be using options located at 160. So the question is how much I get paid for the 160s. It's quite far, to be honest. So let's see. Let's see how much we get paid for the 160. So the 160s are paying 88 cents. Okay, 88 cents. Yeah, it's not gonna work, guys. Anyway, let's try. Let's try. So we're gonna sell the 160. Okay, so we're selling the 160, and then we're buying an option above. So the one above is 162.5, and that is giving you 10 cents of credit. So again, same story as Facebook. That one is not gonna work because again, the distance between strikes is 2.5, isn't it? And you want to collect at least 15% of that, which is 37.5. Okay, and you know it seems that getting the midpoint, which is not always possible, we would get 11 cents. So that is far from 37. Therefore, that one is not going to be taken. So what if I was to do the 165? So if I do the 165, I get paid more. But now my risk, okay, my risk now is $5. So $5 times 15%, I need to collect 75 cents now, and now I get 18 cents. Okay, 18 cents right here. Okay, so it's not good enough. Okay, it's not good enough either. So let me go back to look at the option chain and see if I can spot a bit more liquidity somewhere. So if I do, let me see. Yeah, it's not gonna work. I'm just looking at differentials. Okay, and I don't see any differential that gives me at least $37, $37.50, which is the premium I need to collect to justify that risk. So yeah, so Beyond Meat will not be a candidate, and I will pass on Shopify as well because of the same thing I said about Facebook. It's a close to $1,000 stock. So again, it would be a great one to see, but not used by most. Okay, so therefore we are left with one group because directional short today didn't have any result. Therefore, we will be looking at directional longs. So let's see if we can find a trade to the long side, and if we don't, then we don't. Okay, so we have Fedex. So let's take a look at Fedex. You just run the scan again, many different symbols. I get you, Mark. I get you. Yeah, normally what I do, just to have it kind of standardized, is I run the scan before the market opens, and that's the one I present in the sessions. But I get you. Absolutely. You know, after the session is over, you guys feel free to rerun the scan because often you have new symbols. So, well, Fedex is 46% with pre and post market, so that would not be acceptable. Regular session give us 46% too, so no Fedex for us. What else do we have? NVTA. Let's see. Yeah, well, we're gonna pass on this one. It's a 22 candle climate where statistics suggest it's gonna be 5, so really overextended. WMB. Let me take a look at that one. pending data, just waiting for the chart to load. Here we go. So we got 51%. Okay, so that is indeed acceptable. So let's continue with the plan. Okay, let's continue with the plan. Oh, yes, we do have a trade, my friends. I believe we do have a trade. So pre-post market instead of 51 is 44. So we will ignore pre-post market. We'll stick with regular session data. Okay. So let's begin with the plan. Okay. So what do we have? First, climate, right? So we're looking at the daily time frame. We can see it's a blue and thick dot. So the climate is confirmed. It's pointing to the upside. We should be a buyer, and in order to do so, we want to use our reference point of 1927. This is a reference point, knowing, by the way, that as the stock drops towards 1927, the current price is 2008, right? So then the moving average, the M is there for a reason, it means moving. So the moving average will move, and instead of 1927, may become 1920, 1915. I'm not sure, but to be honest, in stocks, it's not too concerning because stocks, we know already they are a fragile asset, isn't it? And they change, they depend on other external factors. So I don't need to be that precise. But on top of that, if I look at that UFO right there, notice this UFO has a starting point at 1915, which is going to be about the price of that EMA if that stock was to drop to 1915. So in other words, we have an entry, okay, lining up with 1915. So I'm just going to draw a line. Okay, so 1915. I will also draw a vertical line so we know when the trade was planned. So then when we do our review, we can come back to here and double check. So this is the candle. Okay, this is the candle. So we are planning to buy at 19.15 if that stock was to drop to 19.15. I will add it here, WMB. Okay, and the one thing that is missing though is the target. So let's look for a target for that stock. So I'm looking at the daily time frame turn on AutoUFOs, and we can see here a red UFO waiting at 21.25. Okay, so 21.25, that would be the target price for that particular trade, WMB. So analysis 21.25, that would be the target. 21.25, that would be the target, and 19.15, that would be the entry, and the last price slice, we don't need it. Okay, so activation rule for initiating the trade 19.15, activation rule to conclude the trade 21.25. Okay, so we're expecting that movement in price from 19 to 21 on that stock. So if we were to do that, okay, if we were to expose ourselves to this trade, how would we do it? Okay, so here's the whole option chain for WMB. We got multiple expiration dates. The one thing I need to find out is what is the right expiration date for the trade. Okay, and this has to do with calculating what we know as the time to target. Okay, and also checking the I just lost it. Checking the earnings date. Here we go. I got it. So 21.25, that's my target. 19.15, that's my entry. We're talking about $2.1 move. The daily ATR, as you can see, is 67 cents. So if I take 2.1 divided by 0.67, this is telling me 3 ATRs to get to the target. We are giving ourselves 1 week per ATR, that's 7 days. So that's going to be at least 22 days to expiration. That is what we need. So 22 days to expiration would be at least August 7. We cannot use expiration dates prior to that. It has to be at least August 7. Now, having said that, we may even go beyond that, right? So WMB, let's take a look at earnings. Earnings are happening on August 3. And August 3 happens to be falling in that expiration date as well. Okay, that's a very nice coincidence. Okay, even though August 3 is before, it certainly doesn't fall into 31st, it falls into 07. Okay, so notice how very nice to see actually how the August 7 has much less implied volatility, 41 instead of 61. but expect that one to pick up volatility as the earning dates approaches. That's going to offset the time decay effect. Okay, so good. So we are excited to plan a trade on that particular stock. So I'm just going to analyze and buy a vertical spread. I will also analyze to buy a single option. Okay, I will do both, and let's see what happens. Okay, here we go. I will do both and analyze which one is more convenient. So I'm gonna uncheck the single option and start with the spread. Again, the rules that we have to do the trades is to do a spread. We want to sell an option. Okay, so beyond target. Okay, we sell an option. In this case, let's say we're gonna sell the 22 call. Why? Because the target is 21.25, so 22 call seems to be logical. And then the entry is 19, so then probably buying the 20 call would be the way to do it, because we want to buy a call which is between entry and target. Okay, all of this is being done using August 7, 2020 expiration date, knowing that earnings are on August 3. So we need to be out before that date, okay? Even if you didn't reach the target, you need to be out before that date. So let's see what's gonna happen if I do 22 and 20. So let's get that in. So if I sell the 22 and I buy the 20, so what do I get? Well, actually, it's pretty good delta. We need 30 delta at the beginning, okay? So I got 30 delta. So we got that. Our gamma is also positive at the beginning. That's good. But it becomes negative on the target. Actually, it becomes negative and great. Okay, so that's not too good. So I would like to try to help for that gamma to be a bit better. But if I do 23, well, actually, it's pretty okay. It's pretty okay because my gamma became 38 and my delta remains as 33, which is more or less 30. Okay. Now, in any case, I am very concerned to know how much I get paid for the 23. And given the lack of liquidity, I'm going to get paid 3 cents, 10 cents maximum. I'm not sure it's going to be worth it, guys. I'm not sure it's going to be worth it. Probably this trade is going to be better off at just buying a call. So let's see what happens if I buy the 20 call by itself. Okay, if I buy the 20 call by itself, it gives me 37 delta. So that's not good enough. What if I buy, it's too much delta. If I buy the 20.5, now it's giving me 20 delta, which is way too little, right? So 20 gives me too much, 37, 20.5 gives me too little, right? But again, so what's the cost of this option? 54. Okay, 54. So let's call it 55. So what's the most you can lose? 55 per contract. And it's giving you 37 delta at entry and 71 delta at target with positive gamma all the way. Where if you do the spread, okay, if you do the spread, the trade will cost you $52 instead of 53, instead of 55. So you got $3 difference, which is what we saw on the chain. Okay, and then your delta goes from 33 to 48 because your gamma becomes negative. So again, in this case, to me, it's pretty clear. Doing a single call, it's more efficient, and that's the idea. Then we're just gonna buy the 20 call, and that's it. We're just gonna keep it very simple. We're just gonna buy the 20 call. That's it. That's the plan for this trade. Buy the 20 call. Okay, now you buy the 20 call with an activation rule, which is 19.15. So let me do it. Trade. I'm gonna go market price, as you know. They only order, okay, activation rule. So WMB, and if WMB is less than or equal to 19.15, okay, then we will accept this trade. So I'm just gonna place an order, okay, review, So this order is to buy the 20 call that expires on August 7 on WMB. Day order only, because tomorrow we need to review the climate and everything else if we don't get filled today. Activation rule is 1915. So buy that call, but only if the stock reaches 1915 or below today. Okay, that's the plan. I'm gonna click yes, and the order has been sent, and I can see it now in my manage tab how I have a received order with WMB waiting to get filled. Okay, we have it, my friends. We have it. We had the trade of the day. We got a collection of discarded trades as well. We had a review of the trades that we had before, and I'm gonna say that the session is over unless you have any question, guys. So I'm gonna check the chat box, and if you have additional questions, I would like to ask you to type it in. This would be your time. Okay, so let me see questions. Yeah, thanks for that, Mark. For vertical, profit is greater than the loss. Yeah, we talked about not using the vertical. Leland, all good. Wonderful, everybody. Cool. So I guess that the session is over. Hopefully everything went well for you guys. My pleasure, as always, to be your guide in the get together sessions. See you soon again, and we'll continue next time. Keep up the good work, my friend, and remember, if there's anything we can help you with, send an email to support@tradewithufos.com. Take care, everybody. Bye bye.